Hello viewers, welcome to my channel. I am Hashim Ali Khan here. Right now we are doing the problems on final accounts of sole trading concerns. In the previous video I have explained the complete introduction of final accounts of sole trading concern, and also we have done few short problems on final accounts. So now I am continuing with the remaining problems. I hope everybody have got the hard copy problems printout from the link under my description. So take the printout of the problems and keep it ready before watching the video. And first time if you are watching my video, I suggest you to go to the playlist of my channel. I have uploaded a number of videos on different subjects of accounts, finance, management, etc. So now I'm going to start the next problem, that is problem number 8. See the 8th problem. A trader's trial balance contains sundry debtors 50,000, bad debts 1,000. So in the trial balance, these two items are given, that is debtors 50,000 and bad debts are 1,000. It is desired to provide for doubtful debts at 5% of the debtors. So it is asking you to make the adjustment of 5% provision for doubtful debts on debtors. Make the necessary provision and show the treatment in final accounts. Make the provision for doubtful debts and show how it will be dealt in the final accounts. Now, see carefully. As per the trial balance, sundry debtors are given 50,000, bad debts are given 1,000. An adjustment, it is saying provision for doubtful debts are 5% of debtors. It is given in the problem. So 5% of 50,000, 2,500 is the provision for doubtful debts. Now, treatment in final accounts. How it will be treated in final accounts? In profit and loss account debit side, we take bad debts. How much are the bad debts given in the trial balance? 1,000. And to this bad debts of 1,000, how much provision for doubtful debts we are making now? 2,500. So 1,000 plus 2,500, 3,500 will be shown on the debit side of profit and loss account. This is the first treatment. Second treatment, in balance sheet asset side. In balance sheet asset side, sundry debtors are 50,000. From this, we subtract the provision for doubtful debts. Provision for doubtful debts are 2,500. The 50,000 minus 2,500, 47,500 will be shown in the outer column in the balance sheet. Remember, this 1,000 will not be deducted here. All the trial balance items will appear only once, whereas adjustment items will appear twice. This 1,000 is given in the trial balance, so it will appear only once in the profit and loss account. That's all. You should not take anywhere else. 1,000 rupees we have taken in profit and loss account. But this 2,500 is given in adjustments. So this item will appear twice. First, it will be debited to profit and loss account, and again 2,500 will be deducted from debtors in the balance sheet asset side. That's all. This is the treatment of this adjustment in the final accounts. So we have completed 8th problem. Now see the 9th problem. Problem number 9. On 1st January 2013, beginning of the year, provision for bad debts stood at rupees 2,100. So 2,100 is the provision for bad debts at the beginning of the year. During the year, bad debts amounted to 1,800 actual bad debts. At the end of the year, sundry debtors are 50,000. Then the firm wishes to maintain the provision for bad debts at 5% of sundry debtors. So the management of the business has decided that a provision of 5% on debtors should be maintained at the end of the year, and give the necessary journal entries and the provision for bad debts account. So in this problem, it is asking you to pass the journal entry and also to make the provision for doubtful debts account. The new point in this problem is, we are given the opening provision for doubtful debts, we are given the bad debts written off during the year, how much are the debtors at the end of the year, and how much provision for doubtful debts to be made at the end of the year. That's all. This is the provision. Now, as per the trial balance, provision for bad debts 2,100. This 2,100 is the provision for doubtful debts at the beginning of the year. This is given in the trial balance. So this will appear only once. Sundry bad debts. Bad debts are 1,800 rupees. This is also given in the trial balance itself. Then sundry debtors. Sundry debtors are 50,000. Now it is asking you to make the adjustment provision for bad debts 5% of sundry debtors. How much are the sundry debtors at the end of the year? 50,000. On this 50,000 we make a provision for 5%. The 5% of 50,000, 2,500. 2,500 is the new provision for doubtful debts maintained at the end of the year. At the beginning of the year, how much provision was there? 2,100 provision was there. End of the year provision for doubtful debts 2,500. And during the year bad debts are 1,800 rupees. From this data, first entry will be profit and loss account debtor to provision for doubtful debts. Profit and loss account debtor to provision for doubtful debts. This is the entry for provision for doubtful debts. Now, provision for bad debts. It is asking you to make the account of provision for bad debts, right? The provision for bad debts account, debit, credit. Now, provision for bad debts will show credit balance. Provision for bad debts shows a credit balance. The credit side, by balance brought down, opening balance. How much is the opening balance of provision for bad debts? 2,100. I have taken 2,100. When opening balance is taken on the credit side, the closing balance should be taken on the debit side. Closing balance should be taken on the debit side. So here I have taken by balance brought down opening. So here I will write to balance carried down closing. The closing provision how much? 2,500. So 2,500 is the closing provision. The opening provision credit side, closing provision debit side. And during the year, bad debts are 1,800 rupees. Transferring the bad debts to provision for doubtful debts account. Actually, there are two entries for bad debts. The first entry for bad debts is bad debts account debtor to debtors. Bad debts account debtor to debtors. By passing this entry, debtors will come down. Debtors we have credited. Bad debts account we have debited. Now bad debts account should be transferred to provision for doubtful debts account. The entry will be provision for doubtful debts account debtor to bad debts. Provision for doubtful debts account debtor to bad debts. So provision for doubtful debts debit side to bad debts. How much are the bad debts? 1,800. That's all. Now how much is the amount of provision for doubtful debts debited to profit and loss account? Now we'll find out the balancing figure. Debit side 1,800 plus 2,500, 4,300. 1,800 plus 2,500, 4,300 is the total of the debit side. From this, subtract 2,100 minus 2,100. The balancing figure comes to 2,200. This is the provision which is debited to profit and loss account. Provision for doubtful debts during the year debited to profit and loss account is 2,200. That's all. This is the provision for bad debts account. The only thing you have to remember, take the opening balance on credit side, closing balance debit side. And debit side you take the bad debts provided during the year. Bad debts during the year. Then take the balancing figure. That balancing figure is the provision made during the year debited to P&L account. That's it. So we have completed problem number 9. Now problem number 10. See the 10th problem. In a trial balance, debtors appear at 61,000 and creditors 33,000. So in a trial balance of a sole trader, total debtors are 61,000 and total creditors are 33,000 as per the TB trial balance. Make provision for doubtful debts at 5% on debtors and provision for discount on debtors and creditors at 2% after considering the fact. So in this problem, we are simply required to make a provision for doubtful debts at 5% and provision for discount on debtors and creditors at 2%. That's what we have to calculate. Considering the fact that included in debtors is the amount of rupees 1,000 due from Sham, one of the customer, and included in creditors is the amount 3,000 due to Sham. So imagine, this Mr. X is the sole trader. He is having a business. Now Mr. X is having a customer, Sham. The amount due from the customer Sham is 1,000. 1,000 rupees is the amount due from Sham. And this 1,000 is included in debtors. Total debtors are 61,000. Out of that 61,000, 1,000 rupees is due from that person, Sham. And total creditors are 33,000 as per the trial balance. And it is given that amount due from Sham is 3,000. So 3,000 rupees is included in creditors, 1,000 is included in debtors, both from the same person. So Sham is a debtor and also Sham is a creditor. We have to get the 1,000 rupees from Sham and we have to pay 3,000 rupees to Sham. So unnecessary why we have to pay and why we have to receive, we will set off. So how much is the minimum amount? 1,000. Creditors, we have to get 1,000 rupees from Sham and we have to pay 3,000 rupees to Sham. So instead of getting 1,000 and paying 3,000, we'll make a set off. How much is the minimum amount? 1,000. So we'll make a set off of 1,000. So we deduct 1,000 from debtors and we deduct 1,000 from creditors. After deducting 1,000 from debtors and creditors, then we calculate provision for doubtful debts and provision for discount on debtors and creditors. Now see the solution carefully. Total debtors 61,000, total creditors 33,000. Provision for doubtful debts on debtors 5%. Provision for discount on debtors and creditors 2%. This is the information given in the problem. Now amount due from Sham. Sham is the customer. Amount due from Sham is 1,000 debtor. And amount due to Sham. How much is the amount due to Sham? 3,000 creditor. So the lower of the above two amounts, which is the lower of these above two amounts, 1,000 is lower. The lower of the above two amount is 1,000. Hence we deduct 1,000 from debtors and also from creditors. From debtors and creditors we deduct 1,000. The net debtors 61,000 minus 1,000, 60,000 is the net debtors on which we have to make the provision for doubtful debts. Similarly, net creditors 33,000 minus 1,000, 32,000 rupees is the net creditors. Now provision for doubtful debts. Provision for doubtful debts is 5% on debtors, net debtors. How much are the net debtors? 60,000. So 5% of 60,000, it comes to 3,000 rupees. This is the provision for doubtful debts. Now provision for discount on debtors. Provision for discount on debtors will be made on good debtors. Good debtors means total debtors minus provision for doubtful debts. Total debtors minus provision for doubtful debts. Total debtors are 60,000. How much is the provision for doubtful debts? 3,000. So 60,000 minus 3,000, 57,000 rupees are the good debtors. On this 57,000 good debtors, we have to make a provision for discount. Provision for discount. At what percentage? 2%. So 2% of 57,000 is 1,140. This is the provision for discount on debtors. Similarly, provision for discount on creditors. How much is the net creditors? 32,000. 32,000 is the net creditors after setting off 1,000. So 32,000, 2%, 640. 640 is the provision for discount on creditors. Now what is the treatment in final accounts? I am explaining you. Provision for discount on creditors. It is given in the adjustment. It will appear twice. First, provision for discount on creditors will be taken on credit side of profit and loss account. It's an income to the business. It is a discount received from creditors. The provision for discount on creditors will be taken on the credit side of profit and loss account. Again, this provision for discount on creditors will be deducted from creditors on the liability side of the balance sheet. That's all. This is the adjustment regarding provision for discount on creditors. Now, provision for doubtful debts. Now, provision for doubtful debts, it will appear twice. First, provision for doubtful debts will be taken on debit side of P&L account. Again, this provision for doubtful debts will be deducted from debtors on the asset side of the balance sheet. Same treatment we to provide for provision for discount on debtors. Provision for discount on debtors will be debited to P&L account. Again, this provision for discount on debtors will be deducted from good debtors. Good debtors means sundry debtors 60,000 minus provision for doubtful debts 3,000. So 60,000 minus 3,000, 57,000. This 57,000 is called good debtors. From that 57,000, less provision for discount on debtors. How much? 1,140. Deduct 57,000 minus 1,140 and take them out in the outer column. That's all. So this is the end of problem number 10. Now we start the next problem, that is problem number 11. Now see the problem number 11 carefully. On 1st January 2013, the provision for doubtful debts stood at rupees 550. The beginning of the year, 1st January 2013, the provision for doubtful debts is 550. During the year, bad debts written off 400. At the end of the year, the sundry debtors are 10,000. The firm wishes to maintain provision for doubtful debts at 5% on sundry debtors. Give journal entries to be passed on 31st December 2013. Our current year is 2013. Beginning of the year, 1st January, there is opening balance of provision for doubtful debts, 550 rupees. And during the whole year of 2013, bad debts were written off 400 rupees. At the end of the year, 31st December 2013, the total sundry debtors are 10,000 and it is proposed to make a provision for doubtful debts 5% on sundry debtors. So 5% of 10,000, 500 rupees is the closing provision for doubtful debts. Now we are required to pass the journal entry. First of all, we can pass the entry for bad debts. Entry will be bad debts account debtor to debtors account. Bad debts is a loss. It is a dead loss. So entry will be bad debts account debtor to debtors account. How much is the bad debts written off during the year? 400. Right? The second entry will be provision made at the end of the year. Now you can see on the board, journal entries 11th problem, profit and loss account debtor 500 to provision for doubtful debts 500. This 500 we got 5% on sundry debtors. The sundry debtors at the end of the year 10,000. So 5% of 10,000, 500 rupees. So this is the provision for doubtful debts made at the end of the year. At the end of the year. So being the provision for doubtful debts made at 5% on sundry debtors. Now transfer of bad debts. Transfer of bad debts to provision for doubtful debts. The first entry when we create the bad debts, when we made the bad debts account debtor to debtors account. The entry will be bad debts account debtor to debtors. Now this bad debts will be transferred to provision for doubtful debts. The first entry we have debited bad debts. Now second entry we transfer the bad debts, credit the bad debts. The entry will be provision for doubtful debts account debtor to bad debts. How much bad debts? 400. The bad debts are transferred to provision for doubtful debts. Now balance remaining. How much is the balance remaining in provision for doubtful debts? That will be transferred to profit and loss account. So entry will be profit and loss account debtor to provision for doubtful debts. So how we got, how much of the bad debts created during the year? 400. To this we have to add the new provision. Bad debts made during the year 400. Add provision made during the year. So end of the year how much provision we have made? 500. So 400 plus 500, 900. 900 provision में से existing provision will deduct. Existing provision मतलब the provision made at the beginning of the year. The provision which was existing at the beginning of the year. At the beginning of the year 550 provision was there. So here I have written 400 plus 500 minus 550. 400 are the bad debts. 500 is the new provision made at the end of the year. And minus 550. 550 is the old provision which is coming from last year. From last year, opening provision. So, bad debts add new provision less old provision. So, 350 rupees is the amount of provision for doubtful debts transferred to profit and loss account. That's all. These are the journal entries. Problem number 11. Now I am reading out problem number 12. Now see carefully. The reserve for discount on creditors as on 31st December 2012 was 900 rupees. The reserve for discount on creditors at the beginning of the year 900. During the year 2013, discount received from creditors total 1200. On 31st December 2013, the creditors totaled 30,000. The reserve for discount on creditors to be kept is 2% of the creditors. Give the required journal entries and the reserve for discount on creditors account. In this problem, it is asking you to pass the journal entries and also prepare the reserve for discount on creditors account. Just like we can give the discount to debtors, we may receive the discount from creditors, from the suppliers. So discount reserve for discount on creditors is a gain, is an expected gain. Now see, journal entry. The first journal entry, creditors account data to discount received account. It is given in the problem 1200 rupees discount received. From whom we have received? From creditors. So entry will be creditors account data to discount received 1200, being the discount received during the year. Then creditors account data to reserve for discount on creditors. Creditors account data to reserve for discount on creditors. This is the reserve created at the end of the year. At the end of the year. So it is given in the problem 2%. 2% on creditors. Creditors are 30,000. So 2% of 30,000, 600 rupees. 600 rupees is the reserve for creditors at the end of the year. Now, discount received account data to reserve for discount on creditors. This discount received we have credited. We have credited in the first entry. Now we have to close it. We have to transfer this discount received to reserve for discount on creditors. So here in first entry we have credited. Now we debit. So discount received account data to reserve for discount on creditors, 1200 rupees. This 1200 rupees we have transferred. Being the discount received transferred to reserve for discount on creditors. Now last entry will be reserve for discount on creditors account data to profit and loss account. Being the balance remaining in reserve for discount on creditors transferred to profit and loss account. So how we can be able to get this 900 rupees balancing figure? By making an account reserve for discount on creditors account. So reserve for discount on creditors account, by making this we can get the balancing figure which is transferred to profit and loss account. Now see here, debit side to balance brought down. Balance brought down. What is the opening balance of reserve given in the first line? 900 rupees opening. When we have taken opening balance on debit side, the closing balance will be taken on the credit side. So credit side last item by balance carried down 600. Already 600 we have calculated here. 2% of 30,000 is 600. This is the closing balance of reserve for discount on creditors. So opening balance debit side, closing balance credit side. Now discount received. Discount received is transferred to reserve for discount on creditors. Here discount received account data to reserve for discount on creditors. So reserve for discount on creditors should be credited. So credit side by discount received 1200. By discount received 1200. Now we have posted all the journal entries. Now we find the balancing figure. So credit side, if you take the total 1200 plus 600. 1200 plus 600, 1800 is the credit side total. 1800 minus 900. Debit side we have 900. So 1800 minus 900 balancing figure is 900. So this is the profit and loss account balancing figure 900 rupees. This will be transferred to P&L account, last entry. That's all. So this is the end of problem number 12. Come on viewers, now we'll start the next problem, problem number 13. See the 13th problem. Show the treatment of the following items in the profit and loss account and balance sheet prepared at the end of 2013. So it is asking you how these items will be shown in the profit and loss account and balance sheet. What are the items given? Debit, credit, loan. Loan taken at the rate of 10%, taken on 1st January 2013, 20,000 credit column. Interest on loan, debit column 1,500. Deposit at the rate of 12% on 1st January 2013, debit column 10,000. And interest on deposit 500 rupees, credit column. Now see here, in this problem, one asset is there, one liability is there. Loan taken is a liability. The loan taken on 1st January 2013, the loan amount is 20,000. 20,000 rupees is the amount of loan taken on 1st January. The interest payable on that loan is at the rate of 10%. Right? 10%. So 10% of 20,000, 2,000 rupees is the interest for 1 year on loan, right? But interest paid on loan is given in the problem 1500. When we calculate, we are getting 2,000. 10% of 20,000, 2,000 rupees is the interest on loan. But it is given interest on loan 1500 rupees debit column. That means out of 2,000 rupees, 1500 rupees interest was paid and remaining 500 rupees are not paid. Not paid means due, outstanding. So 1500 rupees interest paid, 500 rupees interest outstanding, due. Similarly, deposit. When this business has made a deposit, it is an asset. The deposit was made for 10,000 rupees on 1st January 2013. The rate of interest on deposit is 12%. So if you calculate 12% of 10,000, you will get 1,200. So for 1 year interest on deposit will be 1,200 rupees. But here it is given interest on deposit received is only 500. So out of 1,200 rupees, only 500 rupees interest is received. So 1,200 minus 500, 700 rupees are receivable. Interest of 700 rupees are receivable, not received. So in this problem, we are seeing some hidden adjustments. These are called hidden adjustment. It is not asking you what are the adjustment. By seeing the information given in the problem, we have to decide what are the information, what is the hidden information we require. The hidden information is interest on loan is not fully paid. When we calculate interest on loan, we are getting 2,000, but it is given interest on loan paid only 1,500. So 500 rupees interest on loan is outstanding, due. That is the hidden information. So we have to provide, according to accrual system of accounting, all expenditure of the current year, whether paid or not, should be taken into account. All expenditure of the year, all income of the year, whether received or not, we should take it. So total interest on loan will come to 2,000. 10% of 20,000, 2,000. But interest paid is 1,500 rupees. So 500 rupees interest on loan is outstanding. We have to pass entry for this outstanding interest on loan. Similarly, when we calculate interest on deposit, 12% of 10,000, 1,200 rupees is the interest on deposit. But it is given interest on deposit received only 500 rupees. So remaining 700 rupees interest receivable, we have to make the adjustment. These are called hidden adjustment. So here the provision is hidden adjustment regarding interest on loan and income from investment. So normally in the main problem when we do, these two items will come, interest on loan and interest on deposit. Some hidden information is there. Some adjustment are not given directly in the problem, but they are implied, hence have to be made without being asked. It is understood when 2,000 rupees interest on loan we are getting, but it is given only 1,500 paid. So it is implied that 500 rupees interest on loan is not paid, outstanding. That we have to make a provision. Treatment. While preparing the final accounts for the year 2013, interest payable and interest receivable should also be considered. We should not consider only interest paid and interest received. We should also consider interest payable and interest receivable, right? So interest on loan taken at 10% on rupees 20,000 for 1 year amounts to 2,000. Loan taken 20,000 on 1st January 2013. Rate of interest 10%. So 10% of 20,000, 2,000 rupees the interest for 1 year. But only 1,500 rupees has been paid. So hence 500 rupees interest is outstanding. This is one hidden point. We come to the conclusion. Similarly, interest on deposits at the rate of 12% on 10,000 for 1 year is 1,200 rupees. 10% of 12% of 10,000, 1,200 rupees is the interest receivable. But only 500 rupees is received. In the problem it is given interest on deposit received is only 500. So and 700 rupees is still receivable. We have to receive still 700. These will appear in the profit and loss account and balance sheet as follows. So how it will be represented in profit and loss account and balance sheet, it is asking. So profit and loss account for the year ended. Debit side. Debit side will take expenditure, credit side will take income. So interest paid on loan is expenditure. Interest received on deposit is an income. credit side. So debit side, to interest on loan paid 1500 rupees, add outstanding interest 500 rupees, total interest 2000 rupees, outer column. Here debit side. Credit side, interest received, interest on deposit received is 500 rupees and interest receivable 500 rupees are received. Interest on deposit received 500 and interest receivable is 700. So total interest is 1200. This is the presentation in the profit and loss account. How interest on loan and interest on deposit will be taken in P&L account. Now balance sheet. One asset, one liability. Loan taken is an asset. Deposit made is loan taken is a liability. Deposit made is an asset. So loan taken will be written in the liability side. Liability side, loan taken at 10%, 20,000. Add interest outstanding on loan. Just now we have seen interest outstanding on loan is 500 rupees. The total loan amount due is 20,500. Now come to asset side. On asset side we take the deposit. The deposit at the rate of 12%, 10,000 given in the problem. Interest receivable on deposit is 700. Interest receivable on deposit is 700. So this is the presentation in P&L account and balance sheet regarding the hidden adjustment. What is the hidden adjustment? Interest payable and interest receivable. That is not specified in the problem. By comparing the amounts, we come to the conclusion that there are some adjustment. These are the adjustments. So this is the end of problem number 13.